Good day to everyone. In this video, we will discuss the topic 5 part 1. This topic 5 part 1 is related to the source document and the books of prime entry. There are 5 learning outcomes for this topic. First learning outcome is to state the process of recording a business transaction. Learning outcome number 2, to state the different books of prime entry. Number 3, to state the functions of the general journal and the special journal. Number 4, identify the source documents for the different types of journals. And number 5, post the transactions in the general journal and special journal to the appropriate accounts in ledger. To prepare the accounting records, we have to follow certain steps. These steps are called as the accounting cycle. We will start with the source document, and this source document then will be prepared in the books of prime entry. We have different books in the books of prime entry, such as journal, cash book, and petty cash book. Then we will continue the transactions and record in the ledgers. Ledgers also have different types, such as the general ledger and special ledger. After the ledgers have been prepared, we need to prepare the trial balance. For number 5, adjustment will be done for certain transactions before it is recorded to the adjusted trial balance. After the adjusted trial balance, we need to transfer everything to the financial statements. So in the financial statements, we will prepare SOCI and the SOFP, and then we will proceed to the financial reports and communicate these reports to the users of the financial statements. All these steps will be repeated every accounting period. So for today, in this video, we will cover until step number 3, which is prepare the books of prime entry and transfer to ledgers. What is source document? A source document is a specially designed form which supplies details of a business transactions. It is a written document that provides details of a transaction and the evidence that the transaction has taken place. It contains information like the date, the nature and types of transactions, the value of the transactions, and the names of the buyers and sellers involved. Source documents are important because these documents will become the evidence of the transactions and will be used for the recording transactions. This will also be referred by the auditors in the auditing process. This slide shows the types and usage of source documents. The example of source documents are like invoices. These invoices used in credit transactions only. Cash bill used in cash transactions only. Credit notes used to inform the buyer that his or her account in the books of the seller have been credited, which means debt has been reduced. Debit notes used to inform the buyer that his or her account has been debited with stated amount. Receipts. A receipt is issued by a receiver of payment to the payer for payment made by cash or check. Vouchers, used when a payment has been made but the receipt is not given by the receiver of payment. Memos, used as a notice when there is an increase in capital, drawings, or other extraordinary event. Check butts, evidence that payment has been made by check. This is the example of an invoice where you will have the name of the seller and the buyer, the date of the invoice, the descriptions of the items purchased, together with the discount amount and the amount that need to be paid to the seller. This invoice will become as a reference for the recording's purpose. Based on this slide, you can see the example of the check, payment voucher, credit note, and also the cash bills or cash invoice. So all of these source document will become the reference for the business to make the accounting record, and it will also become the reference for the auditor when it comes to the business to conduct the auditing process. Next, after we receive the source document, all the source document will be recorded in the books of prime entry. What is book of prime entries? Book of prime entry are the first books in which the business transactions are recorded throughout the accounting process. They are also known as the books of original entry or books of first entry. Each transaction recorded must be supported by documentary evidence such as invoices, receipt, cash registers, checks, and others. The following are the main books of prime entry. First, we will have a special journal. This journal is used to record a specific type of transaction only. Under this special journal, we will have sales day book or sales journal, sales returns day book or return inwards journal, purchases day book or purchases journal, and purchases returns day book or return outwards journal. So there are 4 different journals under the special journal. Next, under the books of prime entry, we will also have the journal or the general journal. And number 3, we will have the cash books or petty cash books to record the cash transactions. Next, this slide shows us the relationships of source document, transactions, and the books of prime entry for credit transaction. For a sale invoice, it is related to the credit sales. When it is credit sales transaction, we must record the items inside the sales journals with the double entry of debit debtors credit sales. Next, purchase invoice received. This document will tell us about the credit purchases. Since this is credit purchases, the transaction will be recorded in the purchases journal. Debit purchases, credit creditor. Next, sales credit notes. This document is related to the goods returned by customers. It means as the sales return or return inwards. So we have to record this transaction in the sales returns journal. The double entry will be debit sales return, credit debtors. For number 4, we have the purchases credit notes received. This document is related to the goods returned to suppliers or the purchase return. So it will need to be recorded in the purchases returns journal with the double entry of debit creditors, credit purchases returns, or return outwards. For number 5, we may have the invoices for fixed asset. So, as this is the transaction that not related to our main business activities, we need to record this in the general journal. Okay. For example, when you purchase the machinery. So the purchase of machinery is not part of your raw material. It is your fixed asset. So it must be recorded in the general journal. And last one, we have the checkbook stub or paying in book stub. So this is related to the cash receipt or cash payment. As cash transaction, this should be recorded in the cash book or the petty cash book. Now let us look at the special journal one by one. First, we have sales journal, or we may also call as the sales day book. This is used to record the sales on credit, exclude cash sales of those goods bought specifically for resale. It is written out from copies of the sales invoices retained by the seller. Invoice. An invoice is a business document sent by seller to buyer to perform the letter of the amount due on goods or services supplied. So when we have sale transaction, we may refer to the invoice to know the details of that transaction. The following figure shows the process of recording the information of invoices sent to the buyers into the sales journal and posting it to the ledger. Once we have the credit sales transaction, we will send the sale invoices to our customers. And these credit transactions of sales will be recorded in the sales journal. The double entry will be debit debtors credit sales. Once we already record in the sales journal, we will transfer the transactions into the ledger account according to the double entry involved. Debit debtors credit sales. Next, how to make entries in the sales journal and post the entry to the sales ledger. So first, to make the entries in the sales journal or sales daybook, the details that related to this are date, name of customer, invoice number, folio column, and final amount of invoice. As you can see in the example, we have three different debtors, which are Rara Enterprise, Spice World Enterprise, and the Good Life Trading. So in the sales journal, we will only record the dates of the transaction, the name of the debtors involved, and the amount for each debtors. There is no debit side and credit side in the sales journal. We will only record the list of our debtors with their amount. After we record the sales journal, we will transfer that transactions to the general ledger, and we will involve with the sales ledger for this transaction. To post the credit sales to the sales ledger, we need to credit the sales account and debit the debtors account. Based from the example given, as we have three different debtors, we need to open three different personal debtors account. We will have the Rara Enterprise T account, Spice World Enterprise T account, and Good Life Trading T account. As for the sales transactions, the double entry will be debit debtor credit sale. So for all the debtors T account, we will record the sales amount on the debit side. Whereas for the sales account, we will only record the total amount of the sales on the credit sides of the sales account. This is how we post from the sales journal to the sales ledger. Next, we will continue with the purchases journal or purchases daybook. This is used to record the purchase on credit, exclude cash purchase of those goods intended for resale. It is written up from the invoices received from suppliers. What is the invoice received from supplier? It is an invoice of business document to inform the letter of the due on goods or services supplied. The following figure shows the process of recording the information from invoices received from suppliers into the purchases journal and posting it to the ledger. So when we have the credit purchases, this will need to be recorded in the purchase journal based on the purchase invoice received. In the purchase journal, we will have the information on our purchase transaction. From the purchase journal, we will then transfer to the related ledgers account, which are based on the double entry of debit purchases, credit creditors. This slide will tell us on how to make the entries in the purchases journal and post to the ledger accounts. So first, in the purchases journal or the purchase daybook, the details related are the name of the supplier together with the date, invoice number, folio column, and final amount of the invoice. As you can see in the example given, we have three different creditors, which are Tech Supply Enterprise, Computer Shop, and Data Traveler. In the purchases journal, we will not have any debit side and credit side. What we record only the list of our creditors together with their amount involved. Next, from the purchase journal, we will transfer the items into the ledger account. The ledger account that will be involved with the credit purchase are the creditors and the purchase account, as we are following the double entry of debit, purchase, credit, creditor. So that is why in the personal creditors T account, we will need to record the transactions of each creditor's amount on their credit side. As you can see in the slide given, we have three different creditors account, which are tax supply T account, computer shop T account, and data traveler T account. These are called as the creditor's personal ledger, and the transaction is recorded on the credit side since they are the creditor. As for the purchase T account, the total amount from the purchase journal will be transferred to this purchase T account on the debit side. Next, we will look at the credit notes. Credit notes is actually used for good returns or for amount overcharge. The goods bought on credit are normally written for the following reasons. First, maybe they are defective or damaged. Second, they are not in accordance to the specifications, quality, size, type of the brand name. And then, maybe they are empty bottles, cases, or containers which are returnable. This is the example of the credit note. You will have the information on the name of the seller and purchaser, date of the credit notes, the descriptions of the goods with the amount involved. These credit notes will become the source documents to record the transactions in our accounting books later. Now let us look at the sales returns journal or written in words daybook. This is used to record the goods sold on credit that have been returned by customers. It is written up from copies of the credit notes written by the seller. The following figure shows the process of recording the information of credit notes sent to the customers into the sales returns journal and posting it to the ledger. So, when customer returns goods back to the seller will record these as sales returns. Then, the seller will send out the credit note to the buyer. Once this is delivered and sent, this transaction should be recorded in the sales returns journal. From the sales return journal, the items and the transaction will be posted to the relevant ledger accounts, and the accounts involved will be debit sales returns, credit debtors. In the sales returns journal, we need to credit the amounts of the credit notes one by one to the accounts of the customers in the ledger. In the sales return journal, we just list out the name of the debtors involved with the amounts related. These items from the sales returns journal then will be transferred to the debtors general ledger and the sales returns general ledger. From this example, we have two debtors that involve with the sales returns, which are Rara Enterprise and Spice World Enterprise. That is why we need to open the Rara Enterprise T account and Spice World Enterprise T account together with the sales returns T account. The total amount of the sales return from the sales returns journal will be transferred to the sales returns T account on the debit side, while for each of the debtors items and amount, this will be transferred to the personal debtor account, which are Rara Enterprise on the credit side and Spice World Enterprise on the credit side also. Now we continue to the purchasers returns journals or the return outwards daybook. This is used to record the goods returns on credit that have been returned to suppliers. It is written up from the credit notes received from suppliers as our source document. The following figure shows the process of recording the information from credit notes received from suppliers into the purchasers returns journal and posting it to the ledger. When buyer returns goods to seller, buyer will record as the purchaser's returns. Then, buyer will receive a credit note from the seller. When the buyer receives the credit notes, that amount will be recorded in the purchase returns journal. From the purchase return journals, that items will be transferred to the relevant ledger accounts, which are for the purchase returns. It's related to the debit creditors and credit purchasers returns ledger accounts. To record the purchasers returns in the purchasers return journals or return outwards daybook, we need to debit the amount of the debit notes one by one to the personal accounts of the suppliers in the ledger. In the purchasers returns journal, we will list out the name of the creditors involved together with the date and the amounts. From the purchasers returns journal, then we will transfer the item to the relevant general ledger. For the purchase returns, the double entry involved will be debit creditor and credit purchasers returns. So that is why for the creditor's personal T account, we will record the purchasers return on the debit side. For example, based on the slide, we have two different creditors involved with the purchase return, which are Tech Supply Enterprise and the Computer Shop. So the amount of the purchase return will be debited in the Tech Supply Enterprise T account and also debited in the Computer Shop Personal T account. Whereas for the total purchases returns for that month, the amount of the total will be transferred to the credit side of the purchases returns T account. Now we will look into the general journal. The general journal is usually used to record the following transaction. Number 1, purchase and sale of fixed asset on account. Number 2, other transactions such as drawings, additional capital by the owner and the services charged. Number 3, opening entry. Number 4, closing entry. Number 5, adjustments on balance day. And lastly, the corrections of errors. The general journal basically will record the extraordinary items that occurred during the accounting period. What are the characteristics of general journal? First, you have columns for date, particulars of debit and credit for a transaction. Then you will have a row for brief explanations of the transactions called narrations or narrative. And then this will also act as a book of giving directives. Accounts in the ledger are debited or credited according to the entries in the general journal. As for the example, you can see that we have the format given for the general journal in the slide. Example 1. Purchase of fixed asset on credit. On 11 January, the business bought a delivery van for 30,000 on credit from Safety Enterprise. So the source document involved will be the invoice. The analysis for these transactions, the delivery van and asset increases and is therefore debited, while Safety Enterprise, which is the creditor, is the liability. So when the liability increases, it is therefore credited. For the journal entry, first you record the date, which is on 11 January, then debit motor vehicles 30,000 and credit Safety Enterprise 30,000. For the narrative or the narrations in the bracket here, you can write down as being purchase of a delivery van. To post this double entry or journal entry to ledger, we will follow the debit and credit items in here. For the motor vehicles, we will record 30,000 on the debit side, while for the Safety Enterprise, which is the creditor, we will record it on the credit side with the amount of 30,000. Example 2, owner withdrew goods for personal use, which is drawings. On the January 15, the owner withdrew goods 1,200 ringgit for personal use. So the source document will be the inter-office memo. The analysis for drawings, honest equity decreased and is therefore debited. Purchases, which is an expense, decreased and it is therefore credited. So for the journal entry, our particulars will be debit drawing, credit purchases with the amount of 100 ringgit. The narrative or the narrations will be being withdrawal of goods for personal use. So from this journal entry, we will transfer to the general ledger. So in the drawings account, we will debit 100 ringgit for the purchases, and in the purchases account, we will credit 100 ringgit also for the drawings, and the date will be on the January 15. For the example 3, we have additional capital other than cash. On the January 18, the owner brought in furniture worth 1,500 for office use. So the source document will be the inter-office memo. The analysis, furniture, which is an asset, increases and is therefore debited. Capital, which is the owner's equity, increases and is therefore credited. Therefore, in the journal entry on the January 18th, we will need to debit furniture 1,500 and credit capital 1,500. And for the narrative or the narrations, we can write down as being additional capital in the form of furniture. As usual, to post from the journal entry to the general ledger, we will follow back our journal entry previously. So we need to debit 1,500 in the furniture account and credit 1,500 in the capital account on the same date, which is on January 18. Next is the opening entry. Opening entry is the process of opening a new set of books based on the double entry system. It is necessary when a businessman sets up a business by bringing in assets and liabilities, and B, a new set of accounting records based on the double entry system is introduced to replace an incomplete system of accounting records. For example, on 1st August, Mr. James commenced business with the following assets and liabilities: cash at bank 25,000, cash in hand 1,800, inventory 10,000, delivery van 28,000, premises 80,000, debtors 4,000, and creditors 12,300. So for the analysis, all accounts for assets are debited and all accounts for liabilities are credited. The figure for capital is obtained by subtracting the liabilities from the assets. These are actually using the accounting equations format. Therefore, we will transfer all the asset items on the debit side on the relevant items, such as for the van, premises, cash at bank, cash in hand, inventory, and debtors account. All the items will be recorded on the debit side, while for the creditors, we will record the amount on the credit sides. For the capital, we will need to find or calculate the capital amount by deducting the amount of the liabilities from the amount of the total asset. So based on the calculations, we will have the amount of capital of 136,500. So this will be recorded on the credit side of the capital account. Next is the closing entry. The closing entry is the final entry for a particular period. The closing entry is on the balance day, normally months or year end, in order to determine the profit or loss. So all expenses and the revenues are transferring to the final accounts, which are the trading accounts and the profit and loss account. So basically, from the trading account, we will transfer to the profit and loss account and then to the capital account. This slide shows us the example of the trading account, profit and loss account, and SOCI. Actually, the trading account and profit and loss account are part of the SOCI. In the trading account, we will get the amount of the gross profit. This gross profit amount will then be transferred and continued to prepare the profit and loss account. In the profit and loss account, we will find the amount of the net profit and the net loss. All of these are called as the statement of comprehensive income. The amount of the net profit or the net loss from the statement of the comprehensive income will then be transferred to the statement of the financial position. This will be recorded under the owner's equity section. The net profit will be plus your beginning capital, or if you have net loss, you will need to minus it from the beginning capital minus the drawing amount to get the amounts of the closing capital as at the year end. It is the end of the topic 5 part 1. We will continue the topic 5 part 2 in the next video. Thank you.